Today on the show, Zimbabwe bans use of mercury in mining. Banks reopen in Ethiopia's Mekelle for the first time since war broke out. And South African president reinstates restrictions to control resurgence of COVID cases. Thank you for joining us and welcome to the program. I'm Chimeze Obi Iwagu. Let's get the show started now with the market numbers. And starting off here on the African continent, all the markets we track were in the green at intraday. Nigerian Stock Exchange resumed trading today after the Christmas holiday and looks set to end the day in the positive territory as the main index was up 0.69% at midday, thanks to gains from the industrial and banking sectors. Meanwhile, South Africa's JSE index was also positive, up 0.98%. Kenya closed Monday trading 0.07% up. In the Middle East, the story is different as mixed sentiment was observed at intraday. In the UAE, Dubai's main index was up 0.41%, while the Abu Dhabi index lost 0.39%. Elsewhere in the region, Saudi Arabia's market was up 0.07%, while the Qatari index shaved off 0.47%. And in Europe, stocks opened higher today following a rally in U.S. stocks on Monday. And sentiment in Europe has been buoyed by a rally in U.S. stocks on Monday that came after President Donald Trump signed a $900 billion coronavirus relief package into law. The measure includes a direct payment of $600 to most Americans. Let's bring in Ashutosh Pandey for details. Hello, Ashutosh. Good afternoon. Well, global markets seem to be on a roll, smashing records after records. What's behind the optimism, even with the rising virus cases?
Well, Chimi, thanks a lot for having me. Yes, it's incredible, no? Isn't it? They are rising despite all the pandemic and all the bad news surrounding the pandemic. Clearly, the markets are on a different planet altogether. For now, the global markets are taking positive cues from the stimulus approval by President Trump in the U.S. That has been a major positive. Then the Brexit deal has been a major positive for the European markets, and also the advent of vaccines. Now, what this does is that the markets are looking actually to the next year already. There are many analysts who believe that the markets have in fact factored in the fact that there is going to be recovery ignited by the vaccines, and by the second quarter of next year we would perhaps ease most of the restrictions that are in place, and that is going to bode well for the economic recovery. So that's one thought, and the thought of some others are that perhaps there is more space there, there's more steam left, and the market is only going to go higher from here because they are pointing to higher earnings expectations that analysts have from companies. They believe that there is a lot more steam left in the rally. We never know then. It's very difficult to say at this point who's going to be proven right going forward. Is it the markets have reached that the top point, or there is more steam left there?
And who would you say are the biggest winners of this rally?
Well, undoubtedly, it's been the tech stocks. The technology stocks have been the biggest movers and the biggest winners. We've seen during the pandemic, it was about those stocks that actually contributed to people working from homes, or those stocks that actually people consumed staying in lockdowns. So Netflix comes to mind, and Amazon, because it was delivering a lot of parcels, that is there. Apple, there was a lot of demand for Apple products, Microsoft, Google. But it was Tesla which actually took the cake, having risen around more than 600% this year. And I think that's got to be, that's not so much to do with the pandemic, but more to do with the fact that perhaps it has, the analysts see the company having an edge over other car makers when it comes to a greener future. And these are the main stocks that have actually done well.
Ashutosh, looking behind you, the DAX has joined the party. Tell us more.
Well, absolutely, yes. I mean, for now, you see that the trajectory has gone down. It looks as if the DAX has fallen, but don't be fooled by that. It's still up and doing well. That's because yesterday it touched a record high. DAX is the latest to join the party, you're right. The S&P 500 was already there. The Indian index was there. South Korea was there. Turkey was there. Just so many of them. And in case of Germany, it's been a broad-based rally. All 30 components of the DAX 30 have now recovered their losses from the March low. They all have climbed, and that's how it's a broad-based rally. And the other thing that we should actually keep in mind is that this is mainly an exporter-heavy benchmark, and that's the reason why it's doing so well. The exporters are really doing well because of the global recovery that is taking place, especially in Asia. So these companies have done well. The outstanding performers here in Germany have been Infineon, that's the chip maker. There's been a lot of demand for its chips, especially from the auto industry. And of course, Daimler. Daimler is also riding a wave of demand seen in China for its cars, and also a very positive outlook that the company has given for its cars.
Yeah, well, Ashutosh, clock is ticking to say bye-bye to 2020, but let's continue to keep a track on those numbers there.
Thanks, Jimmy.
And coming back after the bank holiday on Monday, Britain's blue chip share index hit its highest level in over 9 months early today as the global rally continues. Let's talk to Juliana. Hello, Juliana. Good afternoon. The FTSE 100 index was at its highest point since early March. This would be the FTSE 100's best day in 7 weeks. What's driving this optimism, even with the rising COVID-19 cases? Brexit deal or stimulus?
Bit of both, I've got to say, because of course FTSE 100 looks at lots of global leading companies, and the fact that the outgoing President Donald Trump has finally put his ink to that piece of paper, releasing $900 billion worth of stimulus, and of course the Brexit trade deal. If you think about it, for about 4.5 years, Chimeze, in fact since the 2016 June referendum, lots of companies haven't been employing, optimism has been low, so the fact that a free trade deal has finally been passed with Britain's biggest economic trading partner has given much sigh of relief for investors and for the markets. At early trading, the FTSE was up by about 2.5%. It's pretty much kept that way at intraday. The all share is up 2.40%. The FTSE 100 is up by 2.63%, and the FTSE 250, the domestic market, is up by a whopping 3.28%. In the currencies market, the British pound is up against the US dollar by 0.14%. It has dipped against the euro by 0.15%, and it's up on the Japanese yen by 0.05%. Worth mentioning some of the biggest winners. AstraZeneca, their shares are up 4.5% at intraday, and that's because a lot of sources are saying that regulators are very close to giving their vaccine with Oxford University the thumbs up. Also, Intercontinental Hotels Group and International Airlines Group, the BA owner, their shares are also up, as there does seem to be hopes that perhaps travel and leisure stocks will be on the move again.
And talking about Brexit, Chancellor Rishi Sunak suggests EU access for financial services will exceed deal. What's he trying to say here?
Well, what he's trying to say is that when it comes to the 1,225-page document, which lots of people haven't been able to scrutinise, one area that does appear to be lacking is some detail on the financial services and how the financial services, which is absolutely crucial to Britain, is going to interact with their European counterpart. Now, as everybody knows, the service sector is the dominant economic sector here in the UK. It makes up about 80% of GDP, and in fact it also exports about 50% of services to Europe. And this, of course, isn't just hospitality. This is banking, this is solicitors, this is legal advice. And even Prime Minister Boris Johnson, when he was speaking about the deal in the Sunday Telegraph over the weekend, he did say that he does feel as if the financial service sector has been left out of much of this deal. And I think tomorrow, when lawmakers lawmakers who have been recalled into Parliament get to go through that deal, they will be really hammering home on that. So Chancellor Rishi Sunak has been speaking about how the financial service sector in London will be dealing with Brussels, and he says what he's hoping to do is to strike some sort of deal of equivalence, which basically will mean that come 1st of January, the UK financial services sector will be dealing with the EU in exactly the same way it has been doing for decades. So what we're expecting is a memorandum of understanding to be signed between the two parties, and then perhaps all will be well over the next couple of days. But again, you know, it's been 4.5 years. It was a last-minute deal. Even though it sounds like a long text, it is very, very thin. And unfortunately, because we've only got 3 days left, nobody's been able to go for it with a fine tooth comb, which means there are some sectors that are lacking when it comes to detail and continuity.
Well, aside from the Brexit, the whole world is still dealing with the pandemic, and perhaps the winners in this whole pandemic thing are the technology companies, as they are set to have attracted a record £11.2 billion in venture capital funding this year. That's including the creation of 7 unicorn firms valued at more than $1 billion. What's more, can you tell us there?
Well, this is absolutely amazing story, especially for Britain. Britain has been so battered by COVID-19. Of course, across the world it has been, but we've been dealing with COVID and Brexit, and because we are a services sector, the fact that the services sector has been shut off has really dented the GDP. But alas, as you were just speaking in Frankfurt, the technology sector appears to have been proven king, and not just here in the UK, but across Europe. Britain have received the most funding when it comes to boosting up these telecoms and these technological companies. Now, as you said, $15 billion worth of funding. This trumps the funding that they received in 2019, which was $14.8 billion. And not only is this massive, this really does cement Britain as being the centre across the globe for technological innovation. And in fact, that money is the combined total of what was made in continental Europe. As you said, 7 unicorns were made from this investment. That means companies that are worth over $1 billion. We spoke about one of them last week, which was Octopus Energy, a relatively young energy company. They've only been going for about 5 years. Just last week, they received a $200 million investment from Tokyo Gas. They're going to be working in Japan throughout next year. Another huge organisation that raised over $500 million is the challenger bank, Revolut, and digital insurer Key. So this is absolutely amazing news, especially for Boris Johnson's Conservative government, as they try to forge ahead as being the centre for green, clean energy as well as technological innovation.
I'll see you tomorrow, Juliana.
Thank you.
And stocks in Asia Pacific were mixed today following overnight gains on Wall Street that sent the major averages to record highs. In Japan, the Nikkei 225 gained 1.96%, trading at levels not seen since August 1990. South Korea's Kospi was fractionally lower. Mainland Chinese stocks were lower, with the Shanghai Composite down 0.33%, while the Shenzhen Composite dipped 0.338%. Hong Kong's Hang Seng Index gained 1.05%. Shares in Australia rose following their returns from a Monday holiday, with the S&P ASX 200 up 0.44%. And U.S. stock futures were higher early Tuesday morning following a rally that lifted the major averages to fresh record highs. Dow Jones Industrial Average futures traded 152 points higher. S&P 500 and Nasdaq 100 futures also both traded in positive territory. The Dow jumped 204 points earlier in the day, while the S&P 500 and Nasdaq Composite climbed 0.9% and 0.7%. Those gains came after President Donald Trump signed a $900 billion coronavirus relief package into law. The measure includes a direct payment of $600 to most Americans. Monday's rally put the S&P 500 up 15.6% for the year, and the Dow up 6.5% over that time period. The Nasdaq Composite, meanwhile, has surged more than 43% in 2020 as investors flocked into major tech names such as Apple, Amazon, and Facebook. Domestic commodities market update next. And as African countries prepare to kickstart the African Continental Free Trade Agreement come January 1, reports in the Financial Times suggest that most African countries are not ready to implement the terms. But does this paint the true picture? Let's have this conversation on Commodities Market Update with Dumebi Iyeke, research analyst with Financial Derivatives Company. Hello, Dumebi. Compliments of the season and welcome back from your Christmas holiday.
Thank you so much, Chimezie.
And just 3 days to the commencement of the AfCFTA, Financial Times is of the opinion that African countries are not ready to implement the terms of the trade agreement. Having been following this, is this really the case?
I mean, looking at their report, they've outlined quite a number of constraints as to why they're having this opinion. And the constraints range from technological equipment, technological advancements, equipment, infrastructure development, and custom guidelines and procedures in various countries, because this is not just an agreement for one country. I mean, it's a combination of all African countries. And at the moment, looking at their report, we're looking at these constraints coinciding with potential benefits of the trade agreement. AfCFTA in itself is one trade agreement that would create the world's largest, single market of about 1.2 billion consumers and workers. And it has the potential to propel Africa to so much prosperity and growth. Some reports are suggesting that Africa's growth could increase from what it is currently, which is about $2.6 trillion to about $29 trillion by 2050 if this trade agreement is well implemented and all African countries are on board with this agreement and are fully prepared to implement it fully and effectively. So when we look at the constraints, the point could be very valid in terms of like I said earlier, the preparedness of the customs directives, regulation, procedures, and some countries are still battling a lot of bottlenecks in terms of infrastructure development and technology, to make sure that this trade agreement is effectively implemented across board, to ensure that the benefits are moving, to ensure that the benefits are very well achieved in terms of across various countries, like across Nigeria, South Africa. Every country that's going to be on board has to be able to get the benefits and make sure that this trade agreement is effectively implemented.
Now, considering these constraints that you've just outlined, which Financial Times also did mention, if there is a delay eventually, what do you think would be the impact on domestic commodities prices?
Bringing this to Nigeria, in my opinion, I think that the impact on domestic commodities prices right now wouldn't be so much. Why? Because we'll just remain at the price of domestic commodities will remain at what it is currently. The expectation for the AfCFTA and the border reopening coinciding together, the combined effect of these two developments or events, are that number one, there would be a significant increase in trade activities, inflationary pressures would decline, price of commodities, domestic commodities would stabilize, and there will be an increase in employment. But with the situation that we are now, AfCFTA hasn't, kicked in yet. So if there's a delay in the trade agreement, possibilities of these things happening would definitely stall, but the impact on prices would not be, there wouldn't be so much impact on domestic commodities prices. Why? Because we're already in a situation where, we have the border has reopened and the trade agreement hasn't actually kicked in yet.
All right, now you did mention the border reopening. Let's look at unemployment, inflation, and of course, the value of the Naira in relation to this border reopening and, of course, the AfCFTA taking off.
Yeah, as earlier mentioned, the expectation is that with the border reopening and the AfCFTA commencing, there would be, significant increase. There will be a significant increase in manufacturing activities, trading activities, which will in turn, boost economic growth, and domestic commodities prices would also decline and definitely have an impact on inflation, we're expecting that inflation would decline, and at the same time, it would have a significant effect on the currency. But with focus now on the border reopening, as I mentioned earlier, all of these things are expected to happen not not as fast, but it's going to be a slow and a gradual process. And the most important thing is that the trading activities, would definitely pick up. And number one, in terms of employment, the trade sector is one of the job elastic sectors that we have in the country, and it contributes about 16% to GDP. So when there is a significant boost in trading activities, we will definitely see that reflect in our GDP numbers and inflationary pressures and also employment activities. But when we look at this in terms of the naira, all of these commodities that are going to be traded and we're going to be getting a huge supply of are dollar denominated. So with trading activities picking up, even though this is going to have a positive effect on GDP growth and inflation, there would be an increase in forex demand, and if forex supply remains at current levels, there would be heightened demand coinciding with the shortage of forex supply, which could cause the naira to depreciate further as a result of the border reopening. And at the same time, this would also trigger the CBN to stabilize the currency, further depleting the external reserves. So the expectation is that there would be some, boost in forex supply, with the fact that oil prices are currently trading above $50 per barrel. But if there's any shock in that area, there would be a significant hit on our export revenue. But the trend remains the same, that number one, with the border reopening and the trade agreement kicking off, we'll definitely see a significant boost in trading activities, manufacturing activities, and general economic activities, which will in turn, boost economic growth and possibly, taper inflationary pressures. But in terms of currency, in terms of the value of the naira, if there is no significant boost to forex supply and forex demand heightens, we could see the naira depreciate in the near term.
All right, thank you, Dumebi. We appreciate your time, always.
Thank you so much.
Zimbabwe has banned the use of mercury in mining and has adopted regulatory measures for its release from industrial equipment, including boilers, incinerators, and power plants. This comes after the Southern African country ratified the Minamata Convention. The Minamata Convention on Mercury, adopted at the 5th session of the Intergovernmental Committee in Geneva, Switzerland, on 19th of January 2013, is a global treaty whose objective is to protect human health and environment from the adverse effects of mercury. Zimbabwe becomes the 116th country to ratify the treaty and the 51st in Africa. Most small-scale gold miners use mercury for the processing of ore. And banking services have resumed in the capital of Ethiopia's northern Tigray region for the first time since war broke out there on November 4, as the government seeks to restore normality. Prime Minister Abiy Ahmed's government declared victory after seizing Mekele from the former local ruling party, the Tigray People's Liberty Front, on November 28. By mid-December, it was sending civil servants back to work and reopening airspace, while some power and telecoms links were restored after a blackout. Aid agencies have struggled to gain access to Tigray and are concerned about food running out, especially in refugee camps. Abiy's government says the conflict is finished. Ethiopia has an election scheduled for June and is drafting a bill to create a stock market. And South African President Cyril Ramaphosa has reinstated a ban on alcohol sales and ordered the closure of all bars as a necessary step to control a resurgence of the coronavirus, including a new variant of the virus. During a televised address on Monday night, Ramaphosa also announced residents will remain under a nighttime curfew, meaning residents must be inside their home from 9 p.m. until 6 a.m. Medical and security workers are excluded from the curfew. Following an emergency meeting with his cabinet and the National Coronavirus Command Council, Ramaphosa said all indoor and outdoor gatherings will be prohibited for 14 days from midnight on Monday, except for funerals and restaurants, museums, gyms, casinos. Also, anyone caught not wearing a mask in a public place would face a fine and possible jail sentence. So far, South Africa has recorded 1,004 coronavirus cases and 26,735 deaths, according to Johns Hopkins University Coronavirus Resource Center. And that's a wrap on the program. Thank you for watching. I'm Chimize Obi Iwago.